Hi, I'm Rick Squire. I'm a portfolio manager at Acorn Capital, and today I'm talking about the Next Gen Resources Fund. The Next Gen Resources Fund provides diversified exposure to the energy and resources sectors. At Acorn Capital, we think the energy and resources sectors are one of the most inefficient parts of the market, and that's because it's really difficult to price, particularly the explorers and the developers in those two sectors. One of the challenges with that pricing is it takes really strong financial and technical skills to evaluate those companies. At Acorn Capital, we've got 20 years of sector learnings and institutional memory, and we think we have unmatched IP and data in this space. At the core of our sector is our team, which is led by myself and Karina Bader. But we're also supported by Acorn staff, which provide support in trading, risk management, accounts, legal, and Kate McDermott in wholesale for the fund. Where do we see the investment drivers for the resources and energy sectors? When we established the fund 3 years ago, the focus was really on the clean energy transition and the commodities that are needed to facilitate that transition. Now, what was driving that? We saw three key pressure points. There was investor pressure, political pressure, and social pressure. Investor pressure was investors putting pressure on companies to speed up that clean energy transition. In government pressure, examples like the Inflation Reduction Act, where governments are actually implementing policies that again will facilitate or speed up the energy transition. And social pressure is really just people wanting to do the right thing by buying electric vehicles or changing their source of energy. What we've seen, particularly in the last 12 months, is the rise of geopolitical tension. The war in Ukraine has shown that we can no longer rely on authoritarian states to be a dominant source of some of the key commodities that will facilitate that transition. So an extra layer in the drivers is the rise of geopolitical tension. Now, having identified that this is a really good opportunity in the resources and energy space, the next question is, well, where do investors get exposure to that? So if you look at this figure here for resources and energy companies in the top 100, which is based on market capitalisation and the principal source of revenue, if you were going to invest your money proportionally in resources and energy companies in the top 100, what you're getting is predominantly exposure in iron ore. So there's companies like BHP, Rio Tinto, FMG. There is a small amount of exposure to energy and the EV metals like lithium and rare earth elements, and then some gold and other commodities. Now, in marked contrast, if you look at companies that are the resources and energy companies that are outside of the top 100 on the ASX, but have a market cap more than about $10 million, so that being the investment universe for the Next Gen Resources Fund, what you see is the largest sector is actually those EV metals. So those electric vehicle metals like lithium, rare earth elements, copper, cobalt, nickel, and graphite. There's also a large exposure to gold, but energy is still well represented in the field. There's also quite a large exposure to uranium in that group. The other important feature to recognise that there's only 20 companies, 20 resources and energy companies in the top 100 on the ASX, but in the universe for the Next Gen Resources Fund, there's over 600 companies that we see as ideal targets. And so these are across a range from explorers through developers and producers across a range of those commodities. The next thing that I'd like to discuss is our investment process. Now there's a lot of detail in this slide, but there's a couple of key points that I just want to highlight. What we go through is a 5-step process, which you can see from left to right in the main columns. The three steps on the left are part of the quantitative research, and that's where we use our proprietary database. Now this database, which has been built up over the last 20 years, This contains over 1,300 companies and more than 6,500 individual resources comprising the data for all those companies. We break those companies down into producers, developers and explorers. And what we do is routinely we update the database, we run a series of quantitative screens, and then we do a ranking analysis. And that way we can pick out, what are the best gold explorers, what are the best lithium producers, and then we can actually rank those companies according to a variety of metrics to work out which are the most attractive companies in that particular sector or part of the market. Once we've got our short list, we then move to steps 4 and 5, and that's part of the qualitative research that goes in the process. That involves company meetings, site visits, detailed technical reviews of the projects or the companies. And then the final step is portfolio construction, where we pull together the portfolio, thinking about various elements of risk management and diversification. The next thing I'd like to talk about is the use of the Lassonde Curve. So in my talk today, this is probably the one slide that's the most important to understand as an investor. It's a real point of difference to how we think about investing in these sectors at Acorn Capital. What we see is the Lassonde Curve, it's the value cycle that energy and resources companies go through when they move from exploration through development and into production. So on the x-axis is the project advancement. So from left to right, you'll see explorers through developers into production or the producers. The y-axis is the stock valuation. So think of that as $10 million at the bottom up to $1 billion at the top. Now, most people have heard the exciting stories of the explorer that makes a big discovery and they see an exponential rise in the share price. What a lot of the generalists don't realise is soon after that discovery's been made, the share price starts to fall and then goes through a long flat period, and that feature is what was recognised by Pierre Lassonde, and that was the basis for his curve. So what's happening there is when it starts to fall, these speculators who have made 4 or 5 or 10 times their money, they all start to exit because they've made a really good return. But the other investors, maybe some of the larger institutions that are looking for a little bit more detail on the project, are just taking a small weight. And so there are various risks through that development phase. There are risks around the resource, the mineability of the resource, permitting risks, financing risk. Can they actually raise the money that's needed to get it into production? So it's not until they actually get into that production phase that the stock actually reaches its maximum valuation. So at Acorn Capital, what we do is we allocate our funds according to where we think the stock is positioned along the Lassonde Curve. So we do an allocation of 10 to 40% among those explorers. So these are the high risk but high return stocks. So stocks where we think they've got really strong upside. We try to avoid that flat part of the development curve, try to minimise that exposure. And then it's not until we get into that production phase, that's where the bulk of it. So less risky, but still through that growth part of the Lassonde Curve, where we can ultimately maximise the valuation for the company. The other feature about the fund is we're always diversified. So this figure here, it just shows a breakdown of the commodity exposure through time since inception for the fund. And what you see is that we've always made some exposure to commodities because we're never too sure when a commodity is going to take off. But if there is a change in the dynamic, we will tilt. So nice example of that is you look at the oil and gas exposure, that we had a modest amount of exposure in the fund until early 2022 when the war in Ukraine broke out, and suddenly we saw an opportunity where oil and gas prices could increase quite significantly. And so we tilted our exposure, we opened it up and took advantage of that. And then when we saw prices started to maximise, again we started to to do the opposite, and that was to lower that exposure. You can see gold has maintained a reasonably steady exposure, increasing recently as some of the global uncertainty has crept into the market. And we've always maintained strong lithium exposure, increasing rare earth, increasing and decreasing rare earth exposure, according to how we read the market at particular times. In terms of case studies, we just I showed an example of Karoon, which we first invested at Acorn in 2019, but they started out, Karoon being a oil producer. They bought a project in Brazil in the Santos Basin. At the time, it was producing sort of about 10 to 12,000 barrels of oil per day, and so it's a reasonable size production. But they were going to do a workover program and a development program that had the possibility to double or even triple the production off a similar cost base. So we got into we invested in Karoon in that early part of the production curve. Then as it went through that workover program, there was a variety of technical risks, and we spent a lot of time talking to management, thinking about these technical risks, and we weighted the portfolio appropriately. And so the workover program went really well. The share price more than doubled. It was certainly aided by the rising oil price through last year. But even as oil prices tapered in the last few months, the share price for Karoon has held up well because of that increased production, that growing revenue base. So the stock price went up even in a falling commodity market. So it's a really nice example of how understanding that Lassonde curve can actually extract value even in a falling commodity market. So just to wrap up again, the Next Gen Resources Fund provides diversified exposure to the resources and energy sectors. It's managed by sector specialists, myself and Karina Bader, who are both geologists, have really strong financial and technical skills that are needed in this part of the market. We bring to the table at Acorn Capital, we bring over 20 years of industry knowledge and data, and we've got a really strong and really positive track record. So the other thing is to recognise that the Next Gen Resources Fund actually complements holdings in resources and energy stocks in the top 100 because of its focus on a different commodity mix. Thank you very much.